Okay, this is on chapter 13, which deals with accounting for partnerships. So you want to be able to basically kind of construct the different equity accounts for each individual partner. So if we have three partners in this organization, partner A, B, and C, and partner C provides services for the partnership. So sometimes the partners may all have different functions. So in this case, the guy maybe is a manager or involved in the day-to-day operations. So he gets a salary of $50,000. In addition to that, the partnership agreement provides for an interest allocation of 5% of their weighted average capital balance during the year. So then that means if the partners leave money in the partnership, they're earning interest on the money that they leave in there. So again, it's kind of incentive for them to not pull that money out. It tells us that the balance in the capital account for partners A and B was $500,000. Partner C was admitted into the partnership with an initial contribution of $300,000 and on March 31st, so not all year. Then it says, assume that the partner's revenues less expenses, other than the salary that's paid for partner C and those interests that we just talked about, is $400,000. The partnership agreement provides for a sharing ratio of 40% to partner A, 40% to partner B, and then 20% to partner C. So they'd like us to kind of map that income out. Then the next part of it is going to put it into the partner's capital account. So I'm going to actually kind of jump down there because I'm going to combine them. So again, it says to assume that partners A and B started with the $500,000 and then C adds the $300,000. Then we go through the profit split as mentioned above. But then there was some withdrawals. So then partners A and B withdrew $20,000 each, and then partner C withdrew $10,000 each. So we'll kind of put it all together to say, okay, we've got our three partners. So we got partner A, partner B, and partner C. And then we kind of have a total, or at least for some of them we may kind of use that total. Okay, so our first thing is our beginning balance. So partner A has $500,000, partner B has $500,000, then partner C was newly came in. So on 3/31, there's that capital contribution for partner C. And that is $300,000. Okay, so those are their beginning balances in their partnerships account. Then we're going to go through the profit split information. So we go back and say, okay, partner C is entitled to a salary of $50,000. I'm going to leave just a little gap here. So salary, maybe I'll just label that the profit split. Okay, so a salary goes to partner C of $30,000, correct? Or no, sorry, $50,000. Okay, then they each earn interest. They each earn 5% of their balances. So for partner A and B, they each kept $500,000 in the account and earned 5%, and that's for the whole year. So then that's going to be $25,000 in interest for each one of those. Then partner C, they had $300,000, but only for 9 months. So they still get their 5%, but they don't get it for the whole year. So just make sure you calculate it out just for the 9 months. So let me get my calculator there. So if we take 300,000 times 5%, then we multiply that by 9 and divide it by 12, that gives us $11,250. So now if I kind of go over to my profit split column, it told me that the revenues less expenses, other than the two things we've just mapped out, was $400,000. So then after we subtract the $50,000 salary to partner C, that takes it down to $350,000. Then when we subtract our interest, so if we add those three together, that gives us $61,250. If I subtract that from the $350,000, that leaves me $288,750 to split. So you gotta subtract the salaries and the interest first, then we split the rest. So then we go back to the problem. It told us 40%, 40%, and 20%. So then the $288,750 times 40%. Same thing to partner B. And then the remaining 20% to partner C. So that gives us $115,500 for both of those two partners, and then the remainder, $57,750 then to partner C. So then we've effectively allocated out that $400,000 according to the agreement. So again, starting with the salary, then the interest, and then what's left to the partners. Okay, again, we're trying to get to what their ending balances are, so we're going to factor in the withdrawals. So again, the next problem tells us that the partners withdrew $20,000, $20,000, and $10,000. So then we subtract those out, again, because it's money that they're pulling out. So $20,000 to partner A, $20,000 to partner B, and then $10,000 to partner C. Then once we have all those in, then we can total it up for our ending balance. So we've got our beginning balance plus our profit split minus our withdrawals. Okay, so that gives $620,500 to both partner A and B. And then $409,000 then to partner C. So then that would be the ending balance of those partnership accounts. So then you can kind of see how it flows in those accounts, and then how the different partnership agreements can impact what goes into those accounts. And then that is really it for the partnership accounting.